whenever there's a possibility of two different patterns, they would love to drop orders, and you'll usually see that the price will move really, really fast. So here, this looks like a triple bottom, right? This is the US dollar rand. This looks like a triple bottom. This is the first touch, second touch, third touch. At this third touch, I, like others, are looking for a buy entry as a triple bottom so that the price will start moving up. So if you were me, you'd go to the 4-hour chart, look at your 89 moving average. As long as we are below it, it's still a downtrend. So for me personally, I avoid it. I'm avoiding a buy because I know as long as it's below the 89 moving average on the 4-hour, it's most likely still in a downtrend. And if you buy at the support and resistance, because they know people are buying at the support, at this major support, what they do is they just dump their orders. I've done videos on interviews of institutional traders who've talked about this. I forgot his name, where they talk about how at supports they just dump all their orders because they know everyone's buying, so they just dump all their orders. Price dumps while you're buying here, thinking it's a triple bottom and it's a support area. They just dump. So you would have avoided it if you used the 89 moving average, and then we'll start looking for buy opportunities at the second support here. Next, US dollar try. Another way they do that is through candlestick formations. This is a popular one because if you look at some of your brokers, they have funny looking candlesticks which make it very hard for you to actually do your technical analysis. And so you'll find if you're especially a JP Markets trader, you'll remember they had funny candles, and even XM at times. If you compare with the candlesticks on like TradingView, you'll realize that they're very different. And how that affects you is because you'll think this is a double top, and it does look like a double top. So you've seen this first touch, and then you sell here, and then it goes into profit, goes into profit, goes into profit, goes into profit, and then all of a sudden it starts to spike up, and then it pulls back again, and then you probably sell again, and then watch how it's going to push all the way up again. How do you avoid that? You go to the line graph. When you go to the line graph, what tends to happen is you get to see all the beautiful manipulation they tried to do. If you go to the line graph, you'll clearly see that price has not touched here. Yes, there may be funny looking candlesticks, but the truth is price has not touched here. So it may still be a double top. And you just have to be patient until price touches here on the line graph. So that's an excellent way to avoid their manipulation there. And remember, when it's a double top, they know people who use the line graph are still looking for a double top. So you're going to see once price is going to get here, it's going to shove up all the way up here, right? And then knock all the sellers out. And then after it's knocked a few people out, and then it's going to shove down, right? How do you avoid that? Use a divergence. That price is going to shoot up with this line graph. And instead of going all the way up here, you're going to see the indicators looking like it's going to go down while this price is going up. That's what a divergence is. The price on the chart is going up, and then here on the oscillator it will be going down. So we're waiting for a divergence there. Another form of manipulation they use is again on the typical patterns. So you'll see this is a falling wedge. It's clear to everyone who uses patterns this is a falling wedge. So what do they know about falling wedges? Everyone's looking for a buy right here. So this is the first two touches here, third touch, fourth touch. People are looking for a buy at this point. What do? They dump all their orders, knock everyone's stop loss until it breaches this point here. So even those who are like support and resistance and they're not trading patterns, and you're like, this is a support, this is a support. You see, this is a support, 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 major support area. And then price just breaches and knocks people's trades out. So it knocks all your stop losses, unless you have like, 500 pip stop loss. Then you won't get caught. But for the majority, you'll get caught. So how do you avoid that? Remember, 4-hour chart, here's the 89 moving average right here. And as long as we're above that, you're fine. All over here, this was below the 89 moving average. You had no business trying to buy this. And then here's the 89 moving average. There's also a crossover of the 8, the 21, and the 89 moving average at the support and resistance. So first thing I look for on the 4-hour chart is above the 89 moving average if I want to buy. And then I also look for the divergence, which could have been these points here, and then the crossover of the 8 and 21 moving average. Symmetrical triangle. They love these because a lot of people know about them now. Symmetrical triangle is just price getting caught up in between these two areas. Let me just move this line here. So price gets trapped between the symmetrical triangle. And what a lot of people do is that it's really confusing. You don't know whether it's going to go up or whether it's going to go down. So what you should always do is don't try trade the breakout. A lot of people say trade the breakout. What tends to happen is this symmetrical triangle forms, right? And then you buy here, and then all of a sudden it will spike up, spike up, spike up, do really, really well, and then you'll get tempted to add more, add more, add more, and then all of a sudden price touches here and then shoves back down again. So I tend to wait for what happens at these two poles, right? So the symmetrical triangle has formed. I like to leave the breakout to form whatever it does and then push back down, and then I'll look for a buy. The other way is if it fell, I would have waited for a buy opportunity here. So for me, I would have personally waited, but since it's gone up, what I'm going to wait for is for it to touch here and then possibly pull back. And then if it pulls back, then I'll look for a buy opportunity. Another way to buy before it's breaking out is, again, look for the 89 moving average. As you can see, it was above the 89 moving average. Crossover, buy, and hold. As long as you do that before the breakout, you're fine, because even if it continues to go up, you'll just move your stop loss to break even, and then if it continues to go up, you know, life is good. So I'm genuinely looking for a buy opportunity here, but like I said, with these symmetrical triangles, it could go up and then shove back down. So I'm really just waiting, especially with symmetrical triangles. It will look like it's a buy opportunity, and it will shove up to this 89 and then just shove back down. So again, how do you avoid manipulation? Wait for the 89 moving average. That's number one. And then on a symmetrical triangle, wait until it touches the polar side. So either this side, this line here, or if it broke out this side, this line here. So it's in line with these 2 points. You really want to wait for that. You don't want to just dive in, especially with symmetrical triangles. Anything can happen. You really don't know, especially this long downtrend here. You don't want to be caught up when it goes up, touches, and then just shoves back down. You'd rather get ready for a sell position as it touches this area here, and then look for a sell, not for a buy right now. This is the rising wedge. So it's still forming, so it could continue to just go up, 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 and up. And again, like when they know people are looking for a sell, it will shove up, possibly touch this area here to be in line with this pole of the rising wedge, and then we'll look for a sell because they know everyone's trading the same patterns.